Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. Well, when we're looking at the fixed income markets, oftentimes you get the question, just how rich is U.S. credit? And when investors have been looking to allocate funds in the bond market, credit has seemingly been viewed as being perhaps too rich or expensive in relative terms. And this viewpoint has been applied to both the investment grade and high yield universes. And in this podcast, I wanted to provide you with some perspective of just where U.S. corporate bonds reside from a historical basis, utilizing spreads and yield levels. So let's go to spreads first. And as I'm talking to you right now, investment grade spreads are about plus 80 basis points, high yield spreads about 270 basis points. So where does that sit in terms of history? Well, for investment grade, it's essentially the narrowest reading since 1998. And for high yield, you have to go back to 2007. For the record, the all-time lows are plus 51 basis points in 1997 for investment grade and plus 233 basis points in 2007 for high yield. All right. So have we seen this before, or is this new? Well, they're certainly on the tight side. That spreads from a historical perspective. But there have been some non-disruptive episodes where spreads have resided at rather narrow levels for a period of time as well. Not too different from where we sit at the present time. And what do I mean by non-disruptive? Well, just normal economic cycles, kind of a normal Fed policy cycle as well, where we don't have COVID, we don't have a financial crisis, we don't have some of the issues that we saw with respect to corporate governance in the early 2000s. So let's take a look at, quote unquote, a couple of these non-disruptive episodes. So for investment grade, it was basically, say, between 1994 and 1998. where you had the average spread coming in at plus 70 basis points, so actually below where we are right now. And in 2004, 2006, the average was just a little bit higher at about plus 91 basis points. How about high yield? Well, in 1996 and 1997, we had an average spread of plus 280, not too far away from where we are now at plus 270, right? And from 2006 to about mid-2007, the average was 297 basis points, once again below that 300 basis point threshold. So, macroeconomic conditions of good growth, moderating inflation, and a less restrictive Fed monetary policy could provide continued support for U.S. corporates. So let's take a look at yields. As of this writing, investment grade and high yield yields are coming in at 5.37 and 7.34% respectively. Now, due to the rise in Treasury yields since mid-September, investment-grade yields have increased nearly 75 basis points, while high yield rates are up almost 40 basis points, and that's despite this narrowing in spreads that I just illustrated for you. And while these yield levels are down from the recent high watermarks of 2022 and 2023, they remain well above their pre-COVID levels in 2019, which were 2.77% for investment grade and 5.09% for high yield, right? Remember those days? That's why we talk about rates have returned to normal here in fixed income. Now, from an investment perspective, potential headwinds such as these historically tight spreads and an increase in upcoming supply could be offset by the combination of supportive factors, like I mentioned before, from the macro and the Fed, and these elevated yield levels. So as a result, we would rate U.S. corporates as neutral in terms of fixed income asset allocation. So I'm going to end it there. Hope everybody has a great rest of the week and be well.